the way I describe direct indexing to clients is think of it as holding a Vanguard index fund where you get the tax benefits along the way.
Okay.
S&P 500. On the one hand, with a Vanguard S&P fund, just an index fund, you're going to hold a little bit of all 500 companies. With direct indexing, you will hold 200 companies. And so when, let's say, Coca-Cola, one of the 200 companies that you own, takes a nosedive, well, likely Pepsi will take a nosedive as well as substantially similar stock inside the S&P 500. When that happens with direct indexing, they will sell Coca-Cola and then turn around and buy Pepsi the next day or the same hour. You cannot do that in an index fund. You can't do that anywhere. You cannot sell Coca-Cola, then turn around and buy Coca-Cola. You have to wait 31 days. And so in this case, you're actually selling Coca-Cola, taking the loss on Coca-Cola, but you're tracking the same index by buying a substantially similar stock. So the goal here is that you are tracking the index, whatever that index is, S&P 500, let's say, look, I want to keep pace with the performance of the S&P 500. Well, you're doing that by buying substantially similar stocks, but the difference is you're taking those losses along the way. So if a client invests $1 million into a direct indexing, let's say we want to track the S&P 500, it looks, in every report that I show clients, you can show a monthly or even daily report of how your tracking is. Direct indexing versus S&P 500, it's almost identical. And you can also see the tax benefit that you have incurred along the way. The more volatile the market, the better the taxes, because they're selling more and more stocks. Generally, I tell clients that you can expect in the early years somewhere between maybe 15%, that's $150,000 tax deductions that you can take against oil and gas dividends, multifamily dividends. You cannot take it against your ordinary income, but you can take it against passive income or portfolio income. So that's $150,000, 15% in a normal market. If it's super volatile, maybe that kicks up to 25, 30% in year one, especially if you invest in January, not in June. The more time during the year you have to generate these losses, the better in that year.
So what type of investor would use a direct index?
I think the minimums with Vanguard are $250,000. So, and this is post-tax money. You can't put rollover IRA money or Roth IRA money in this. So that's one, is somebody that has
barrier to entry, 250,000. Could you use this tax strategy for someone who's going to sell a surgery center in the future, or one of do they have a company they're going to sell? If they know they're going to sell something in 5 years or 2 years, 10 years, I mean, would this strategy help?
Absolutely. I mean, yes. So that's yes. So if a client comes to me and says, look, like, I'm going to have a sale in the next 3 years, or maybe I just had a sale, these losses can be taken against those passive gains from the sale of a business. Now, you may say, well, that sale is not going to happen for 3 years. Fantastic. Generate the losses. Whatever you don't use that year will just carry over to the next year. And hopefully you generate, or you can sort of carry over enough losses so that when you do have that sale, you potentially might not pay any taxes on that sale at all because of the carryover losses that you've been doing for the last 3 to 5 years.
Yeah. So that's perfect. What I usually tell clients is it's very similar, but look, the S&P 500, to your example, it did really well last year, performed roughly over 20%. And if you invested in the S&P 500, you're really happy because you got a very nice return. Had you invested in the direct index and you modeled after the S&P 500, you too would have received the 20% return. But did you know that over 30% of the holdings of the companies in the S&P 500, over 30% actually lost money? Which means the fund did great, 20%, but there were still 30% of the holdings that were losers. So if you were in direct indexing, you could have had the same return, but you would have captured those 30% losses along the way. And that's really what it comes down to, is what did you do with those 30% losses?
Yeah, I love that.
And you said it well, right? We offset all of these passive gains that we're getting from our alternative partners. Maybe it's a future sale. there's never going to be a time where you don't need losses at some point, and there's no expiration date on them.
No, I love that. I mean, look, you're getting the gains, but you're not taking advantage of the losses when you put your money in an index fund. Direct indexing takes advantage of those losses while it captures the performance.
And it's liquid too. It trades just like, if we were in a brokerage account. So to us, it really the only downside that I can see is the cost of it. I believe we're at around 20 basis points.
Yeah, I mean, which is super low. I mean,
when you're talking about 20 basis points, it's hard to put that in perspective.
Yeah.
But if 1% is 100 basis points, this is less than 0.25% that they're charging. And that's more than what our internal fees are on our portfolios because we're very, very fee conscious. But the tax alpha, what you get to keep after those losses, is still more relative to the fee, but it's certainly something to discuss. But other than that, for our clientele, it seems to make a lot of sense.